All right, in Money Flow today, our guest is a hedge fund manager whose $400 million fund gained 17% last year, though he is not as bullish now because of concerns about the U.S. economy and markets in China overheating. He is betting on more upside in precious metals, though, including grain and wheat. Nico Harachi, managing director at X1 Fund Distribution. He joins us from our studios upside in Hong Kong now. Nico, good morning. Good to see you. I mean, we're always interested, very interested, in fact, to talk to hedge fund people because we know, starting, mid last year or so, hedge funds got killed exposure in commodities, not least, of course, natural gas. So I guess the big question we've been asking for quite a while is, how are they going to make up the difference? What about yourself?
Well, good morning, Martin. It's good to be here. The hedge fund year has seen, or the hedge fund industry has seen some difficult years the last 2 to 3 years. However, we are happy that we've been able to continue posting a positive performance for our investors. Last year, as you said, we gained around 17%. Now, where do we see good performance for our fund in the next year? Well, we do see it in the convertible arbitrage market. We saw a lot of people pull out of the convertible arbitrage market in 2005 due to, I would say, a large inflow of liquidity. However, we think that due to 3 reasons, we will see the convertible arbitrage managers doing good in 2007. We think we will see new issuance. We will see a pickup in volatility. And we also believe that the Fed may come out in the second half of 2007 and cut rates. So we believe that convertible arbitrage managers will benefit from these 3 factors.
Okay, we'll talk about a pickup in volatility coming up in just a bit because our guest host Gerard Lyons, who's sitting next to me, is also seeing this happen this year. Let's get back to what you see upside in, though. Precious metals, grains, and wheat. I mean, if you take a look back, Gail, we can bring up the Reuters CRB index. Since about, we've seen a very sharp fall, about a 20% fall or so. Technically, that sounds like a bear market to me, what a lot of people are thinking as well. What about yourself?
Well, you're right about that. And if we look at the, agricultural commodities, this sector has in fact been the worst performing sector throughout the current commodity cycle. Now, total returns since 2002 stand only at 16%. Compared to a 3 to 4-fold increase in energy or precious metals. However, our bullish view is driven by the tightening market balance that we're seeing in corn and wheat, where the world-ending stocks came in last year around the lowest level since 1983. So we do think that these prices, in terms of corn and wheat, had already been priced in, but we do see that some further tightness, and we believe that the markets will overshoot fundamentals as long as the alternative fuels debate remains prominent.
Yeah, Gerard Lyons here, Nico. I'm interested in your overall views, but it'd be good to get your insights as to how you think hedge funds are impacting some of these markets. You mentioned the soft commodities. We've seen lots of speculative funds in those markets in recent years, which mean they've moved out of line with fundamentals. When one looks at some of the broader indices, particularly the currency markets, there's a concentration of risk in many of these trending markets because of hedge funds. How do you see these markets reacting, particularly as we move through the first quarter?
I'm sorry, I did not understand which index you mentioned.
Yeah, well, I'm asking you more generally about the impact of hedge funds in terms of influencing these markets, particularly as we've seen it in terms of the soft commodities. We've seen a big move out of line with fundamentals because so much speculative activity has gone on in recent years. And do you think that speculative activity, because of hedge funds, is more evident in some of the broader indices as well?
Well, we sure do. Obviously, also as the hedge fund markets have been booming in the last few years and there are coming more inflows, we will see, I think, also, as I said before, more volatilities across the border. And we do think it will be harder to evaluate and actually foresee the markets since it's you have so many more views flowing into the markets.
Nico, why do you see volatility coming back? I mean, Gerard and I a couple of seconds ago were talking about how, if you take a look at any number of parameters, emerging market debt spreads, if you take a look at, risk just doesn't seem to be there. There is a concern that maybe everybody's just a little bit too complacent.
That's true. But we see more liquidity coming into the market. But if we just look a little bit at the U.S. economy, we're seeing a low employment at 4.5, almost full employment. We're seeing very low oil prices, and we're seeing low wage inflation. So investors have also been spoiled with a one-way street going since 2002 in the stock markets. But we are bearish on the US economy, and we think there are many people that will see that the capital markets would take their cue from persistent despair in the US housing market. So we believe that due to these factors, we will see more volatility.
All right, Nico, good to talk to you, sir. Just out of time. Got to leave it there. Nico Hirachi, Managing Director, X1 Fund Distribution from our studios up in Hong Kong.